Thank you, Yogesh Bhai, for excellent disposition on and your dissection of all the transfer pricing provision in the UAE corporate tax law with a practical insight on how to determine the arm's length price, etc. Thank you very much, Yogesh Bhai. Your vast experience was very much evident in your talk. Now, I will take you through free zone person because that is the another advantage, interesting proposition or doubt which is there in the various people mind. What will be the how the free zone will be taxed or etc. So coming back on free zone, so Article 18 is saying who are the qualifying free zone person, and there are 5 conditions which they have mentioned. The first and foremost is the qualified free zone person is a person that meets all, first of all the conditions. So please bear in mind, they are all cumulative conditions. It cannot be only one or all. All the condition needs to be satisfied to be entitled yourself as a qualified free zone person. And first and foremost is a maintain adequate substance in the state. And this is the most critical requirement as I understand it. And I will take you through why it is so critical. Second is deriving qualifying income, which is yet a cabinet decision will come for the same. So till that, what is qualifying income? Nobody can say. Has elected to be and has elected not to be subject. The option is with the SSE that even though I am qualifying business person, but I want to pay tax at 9%. So if that election under Article 19 has been done, then nothing required for a qualifying free zone person to be in. Complies with Article 34 and 35 transfer pricing requirement, which Yogesh Bhai has explained to us in detail what are the TP requirements. And last is meet any other condition as may be prescribed by the minister. So most important is a maintain adequate substance in the state. Here, without further ado, one more thing let me explain to you is the corporate tax rate. Friends, for the qualifying free zone person, the rate prescribed is 0% on qualifying income. So on qualifying income, you will be having 0% tax. However, for the non-qualifying income, it is 9%. And 9% is even if you earn 100 of dirhams of non-qualifying income, you have to pay 9% tax. That basic threshold exemption of 375,000 dirhams is not applicable to qualifying free zone person. That needs to be kept in mind. As I explained to you, I want to pay tax in free zone, then what? Yes, you can pay the tax in free zone. However, then you will go to a normal tax base, that is 0% up to level of 375,000, and what is in excess of 375,000, you will pay 9% tax. Friend, now the question, that first important criteria that free zone qualifying person needs to maintain adequate substance in the state. Now, adequate substance is not specified or clarified in the law. However, under UAE adopted economic substance regulations in 2019 along with various countries, which you can see on the screen. And there, one of the major requirement is to make the economic substance test following other conditions that conducts core income generating activity in the state. So person has to conduct core income generating activity where in the statement in the UAE. It has to be directed and managed in the state. The direction and management has to be in the UAE. And friend, this cannot be outsourced. Other activity as we go along, that can be outsourced. However, direction and management of the entity, that cannot be outsourced. Adequate number of qualified, friends, mark the word, qualified full-time employee. It is not that we have, just for an example, we have kept 2 receptionist type person, 3 peon type person. I have a 5 person and I can say I have satisfied that criteria. No, they are saying adequate number of qualified full-time employee in relation to that activity, and that person has to be physically present in the state. This may include temporary or a long-term contract person or even outsourced person. The person may not be in your visa also. Outsourced person means I can give it to an outside agency also. That is also allowed as per the economic substance regulation. Operating expenditure needs to be incurred in the state, and there has to be adequate physical asset in the state. If SIGA, that is core income generating activity, is carried out by a third party provider, that third party provider also has to be in UAE, because all other tests also requires to be in UAE. So SIGA, if you have outsourced, it's required to be in UAE. Then license entity, that is license activity, has to ability to monitor and control the activity of third service provider. That needs to be demonstrated, and that will be questioned in case of ESR audit, how you have done, how you are able to monitor and control the outsource activity. And one more thing, we have many times said adequate. ESR law is very clear, no minimum threshold or definition for adequate. However, in the law itself, they said pragmatic view needs to be taken based on the nature and level of activity carried out and level of income earned by the licensee. So this needs to be kept in mind. Second, most important, directed and managed in the state. As I told you, directed and managed in the state, this function cannot be outsourced to anybody. How we will have to see? The board of directors meets in the UAE at an adequate frequency, and there is quorum of director physically present in the state. Now, adequate frequency, why they have made adequate frequency depends on the business, depends on the activity which they have carried out. If 500 million worth of business is carried out and they are huge transaction, then of course board needs to make much more. Otherwise, law even says that meeting once or twice also is fine. The meetings needs to be recorded and signed by director attending the meeting. Secondly, and one more thing, friends, you please note, board of director have to be physically present in the state. That means they need to visit to UAE and attend the board meeting. Only at the time of COVID, the ministry had come out with a circular that virtual meeting will be fine. But that was applicable only at the time of COVID. Now, once again, and as the law required when it was initiated in implemented in 2019, physical attendance of all the directors in the state, in the UAE is required. Secondly, directors also need to have necessary knowledge and expertise to discharge their duty. It cannot be that directors are anybody. They don't know the business. Just for the various purpose to comply with maybe various regulation or poem test. I have just mentioned that I have a UAE resident director, maybe CSP, corporate service provider, has provided some director. Now that may not satisfy the test of economic substance test. The director should have necessary knowledge and expertise to discharge their duties as a director and manage the business. Then minutes of the whole meeting needs to be kept in the state. If it is managed by the manager needs to be physically present in the state. This now, what will happen if I fail the ESR test? So ESR test, if I am failing in the first year, then there will be information exchange with the foreign competent authorities under exchange of information. Under exchange of information, I can exchange the information with the parent company or competent authority of the parent company, ultimate parent company, or the ultimate beneficial owner. But friend, look, this is for the first year. For the second year, this information, of course, will be exchanged, and the relevant regulatory authority can suspend or withdrawal or non-renewal of the trade or commercial license. This is more important. The financial penalty figures I am not mentioning, because that is not the important. What the point which I wanted to drive home is the 2 years this non-violations is continuing, even the authority can say we will not renew your trade license. And second, they will automatic exchange of information with your parent company or with the any ultimate parent company. Or these are the two important points which I wanted to make here. Now, fixed place of P. Now, Article 14 of this decree law is saying that a place of management, or where management and commercial decisions that are necessary for the conduct of business are in substance made, then it can be construed as a fixed place of permanent establishment. Friends, this definition or this limb of the definition that has been given only in the UAE commercial UAE city law. However, OECD, when it is giving the definition of fixed place P, this line or this first limb is not there. But what is coming out? Because we are talking maintaining adequate substance, and that is the why reason I am connecting the dots wherever possible from other laws or from the city law where it can be connected. So following are the key things which needs to be considered. Key management and commercial decision needs to be taken. So decision test is there, that are necessary for the conduct of business. So necessity test needs to be satisfied of an entity as a whole. So pervasive test needs to be satisfied. Are in substance made. So substance test needs to be satisfied. All above 4 tests are to be satisfied in the relevant year. So we need to test this, all these 4 tests year on year basis. And this I have already covered, that this is as per UAE corporate law and not as per OECD definition of fixed place P. Now, question may arise, what are the illustrations of the management decision? It can be by way of appointment or termination of a key management personnel and their remuneration, organizational reporting structure and key organization or management policy decision, code of conduct, group ethos and ethics, global IT system policy and MIS reporting, merger and acquisition or company restructuring decision, including disinvestment, common procurement or sourcing for the group, including master arrangement. These are all illustration of management decision, because as I told you, management and commercial decision that are necessary for the conduct of business are in substance made. So these are the illustration of the management decision. These are the illustration of the commercial decision. That is sourcing of raw material, selection of distributors, and its quality control, procedure and manner in relation to negotiation or execution of contract, particularly long-term contract, including lease in, lease out, borrowing, debt financing, capital sourcing, product portfolio or methods of manufacture, pricing of products and services, expansion and modernization, choice of accounting policy, research and development, brand and patent registration licenses, etc. So these are the definition or illustration of commercial decision. In the previous slide, we saw management decision. And friends, please note that operation decision needs to be distinguished from key management and commercial decision while establishing the adequate substance test. Operation decision can be taken anywhere. However, management and commercial decision, as the fixed place P definition of UAE CT or in the ESR, economic substance regulation, needs to be taken. And very interesting that in following cases, the PE of foreign companies was held to be in India. Delhi High Court decision in case of a GE Energy Parts, which has been pronounced on 2018, and Chennai IT80 decision in of Reddington Distribution Pte Limited, which was judgment dated 16 November 2022. Why I am referring to this judgment? So friends, if you don't have a maintained adequate substance in the state for the purpose of Article 18 to qualify as a free zone person, that can be one implication. You will miss, you will come out of the definition of qualified free zone person. So you will be required to pay the tax at the 9% of all total income earned by the free zone entity. Further, say for example, control and management, everything is done from India. For an example, of if the company or free zone company is a subsidiary of India, and all the control and management, all these managerial and commercial decisions are taken from India, and in these cases of Reddington or etc., where these companies or UAE companies merely doing shipment of the goods, all other things, all other functions are carried out from India, then in India, UAE company fixed place P will be created in India. So UAE company fixed place P is created in India. And what is the implication of that? That this UAE company will have to comply with all the requirements of Indian income tax, PAN, filing of income, etc., etc. Further, second aspect, UAE company, this free zone company which we are discussing, which is subsidiary of a, say, Indian parent, then UAE company may be required to take necessary permission under FEMA rules. RBI permission may be required. So there are two ways. You are losing on free zone qualifying person definition, paying tax on complete income. Further, if the P is established in India, then there will be attribution of profit rules will apply. And what is the profit which is earned by UAE entity? How much we need to attribute to PE in India, that is fixed place PE in India. Of course, that is a separate topic I don't want to go into now. So that appropriation of profit to PE will come. Say for example, 100 dirham is a profit, and if it is decided and agreed that 70% is a profit attributable to PE in India, so 70 will be taxed in India, 30 will be taxed in UAE. So these are very wide repercussion under a foreign PE rules. Then ESR, suppose you are carrying out relevant activity and you are not satisfying the criteria, then there could be a possibility or financial penalties may be given, but major, if the violation continues for 2 years in a row, authority may discontinue or not renew your license. So any free zone company, if it is a subsidiary of say India is an example which I am taking, Indian parent, there are three implications. One, you will lose the free zone free zone qualifying free zone person 0% criteria. You will be subjected on total income on 9%. Second, you will be, if you are carrying on relevant activity, any of the 9 relevant activity, and the substance is not proved in UAE, then ESR non-violence will also apply. And if the commercial and management decision are taken from, for an example, from a place anywhere other places of the world, there are chances that fixed place P can be established in that country, and you have to comply with all the rules and regulation of that country, and attribution of profit rules for the P will also needs to be considered. One more place where I can found, or it can be the place of effective management POEM test, and it's also OECD also provides the same this thing, that OECD master commentary provides that POEM is a place where key management and commercial decisions that are necessary for the conduct of business as a whole are in substance made, and that all relevant facts must be examined to determine the POEM, and where the residence of two companies is dual residence is there, then how the competent authorities of both the countries will decide, and maybe we have to go through the procedure of MAP, mutual agreement procedures, where, and paragraph 24(1) of the master commentary is saying that place where the key and management, what factors they will consider, same, more or less same, but just for a place where the key management and commercial decisions that are necessary for the conduct of entity business as a whole are in substance made, place where the action to be taken by entity as a whole are determined, place where majority of board or directors or equivalent body usually meet, location of and function performed at the headquarters of the entity, place where the chief executive officer or other senior executive usually carry out their activities, where the corporate books of accounts are maintained, which country law governs the legal status of the person, whether determining POEM in one contracting state would lead to improper use of benefit under double tax avoidance agreement. All these factors needs into consideration before determining where the place of effective management test is then done. Rajiv bhai, what we are going to do, tax group shall I take, or we go for a panel discussion because of the paucity of time?
You can take tax group, sir. That's fine, I think.
Yeah. Tax group, that is another concept. We all are very familiar with the tax group under VAT, this thing. So VAT also tax group have been formed, but please note that VAT tax group, criterias for VAT tax group and criterias for the income tax groups are totally different. Here, UAE resident group of companies. So first of all, there has to be a juridical person. Individuals cannot make a tax group. Point one. Point two is, if the parent company, don't confuse yourself with the parent, means a parent and subsidiary as we understand from the IFRS angle or accounting angle. One of the entities who takes that I will take the responsibility can be mentioned as a parent as far as provision of this tax law is concerned. So parent company that holds at least 95% of the share capital, voting right, and profit and net asset of its subsidiary. 95% of share capital, voting right, and profit, directly or indirectly, both are covered. And neither the parent company nor any subsidiary can be exempt. Any exempt person, that company cannot be included in the tax group. Free zone person, once again, and which is qualified as a qualified free zone person, then the benefit or which is taking 0% CT rate, that cannot be added for the tax group. And all group member must follow the same financial year, and their accounts needs to be prepared under same accounting principle, say for example under IFRS. So these are the 5 conditions which needs to be prescribed, satisfied before an UAE residence companies can form a tax group. So let us understand by a way of example. So parent company which is in the mainland, there are 95% subsidiary in the mainland, 40% subsidiary in the mainland, 100% subsidiary, but they are paying 0% corporate tax rate, exempt entity, and 100% subsidiary at standard CT rate of 9%. So in which this case, the parent company can form a tax group with 95% subsidiary mainland company and 100% subsidiary, which is standard rated CT. It cannot form with 40% because 95% criteria as mentioned by me is not satisfied, and 100% subsidiary. But since the rate of taxation is zero or it is an exempt person, then that company cannot be formed the part of the tax group. Second is, as we mentioned, they need to follow the same financial year. So suppose the parent company is following financial year Jan to December. You have 95% subsidiary which is following Jan to December, 40% subsidiary which is following April to March, 100% subsidiary once again January to December, and 100% subsidiary which is paying standard city rate at 9%. It has a financial year, that is April to March. Since in case of a last, this three cases, first, here the accounting year itself is wrong. From Jan to December, in case of 40%, it is April to March. 100% because it is paying 0% tax, it cannot form part of CT, irrespective whether the year is same or otherwise. Third case, 100% subsidiary at a standard CT rate, financial year will apply, but April to March, since their year end is different, which is not matching with the year end of the parent company, this cannot be part of the tax group. Once tax group is formed, of course, as we know, then it will be a single taxable person. Mind well, once the tax group is formed, and there are, say for example, 5 entities or 5 companies, we are forming a tax group. The basic exemption threshold of 375,000 as specified in cabinet decision number 1, that will be applicable only once. You cannot say I have 5 companies in the tax group, so my basic exemption threshold should be 375 into 5. No, that will not be the case. You will be only allowed 375,000 basic exemption once. Secondly, there will be requirement to prepare consolidated financial statement of account. So that will be another, because the starting point of computation of taxable income under Article 28 is profit, net profit as per the financial statement. Here, since the tax groups are there, so consolidated financial statement will be required. One more thing which I would like to add now is, it is advisable and many auditors will require that standalone financial statement are also required to be prepared. And when you are preparing standalone financial statement, you will need to consider transfer pricing provision, even though while consolidated financial statement, all this transaction, intercompany transaction, intercompany balance will be eliminated. However, when you prepare standalone financial statement of each subsidiary and parent company, they will require to be maintained on an arm's length price. Why? Because if you see subsequent various articles of the law, they are saying if the subsidiary is going to leave or any subsidiary is going to come, how we are going to adjust the profit or losses. So that is the reason why standalone financial statement preparation is also very, very important. And maybe that has to be as per the arm's length principle. I think here I will stop for the paucity of time. And Rajiv bhai, now I give it back to Simran further this thing. Thank you. Thank you.
With this, we have come towards the end of the presentation, and now it's time for us to take some of the live questions that is posted by a lot of you. And for this, I would like to first invite CA Rajiv Hira and CA Drushti Desai. Let me just introduce them. CA Rajiv Hira, who is a high caliber financial professional with an experience of leading roles in private and multinational financial institutions for over 25 years, in risk management, compliance, investment analysis, investment management, taxation advisory, and management consulting. He has a wide experience of working in Asia, Africa, and Middle East, and actively working in the UAE with large corporates, SMEs, and individuals on indirect tax implementation advisory and transactional advisory. He has contributed to development of resources through structured training, seminars, and articles, and has a hands-on experience in engaging with regulators and governing bodies in the space of anti-money laundering and counterterrorism financing. His work involves understanding the strategic intent and implementation objectives for compliance. CA Drushti Desai, who is a fellow chartered accountant of the Institute of Chartered Accountants of India, holding Certificate of Practice and is registered valuer under the Companies Act 2013. CA Drushti is currently a partner with BANSI S, METHA CO, a leading firm of chartered accountants in Mumbai, and was the vice chairman of the Western Indian region of the Institute of Chartered Accountants of India for 21 to 22. She is a co-opted member of the Valuation Standard Boards of the ICAI, as also part of subgroup formed under the said board for formulation of valuation standards, and has actively contributed to the drafting of the standards. Her work profile includes a rich blend of experience in valuations and corporate restructuring, with specialization in the areas of business valuations, valuation of intangibles, advisory in the field of mergers, acquisitions, spin-offs, restructuring, and family settlements, due diligences, etc. Over to you to answer all the questions that the audience have posted.
Thanks, Simran. Thank you, Yogesh ji and Janak ji, for the wonderful startup first thing. So thanks, Rishti, also for joining the session. I can't see you, Drishti, as part of the platform. Maybe, yeah, you are there.
Yeah, there.
So just one,
She is there. She is there.
maybe, okay. Thanks all for the time and efforts you have taken to share the insights. I think I will say we are still digging up what all is there in the law, and I think we'll be digging it for next couple of years also. So it's not something which we can get into all the pointers as it's done, because we've seen the countries which have taxes for more than 50 years still, the case laws, the interpretation things comes into play. So that's, I think, the biggest thing what we are doing is sharing the knowledge, looking at the experiences which we have, and start from there. This is maybe one point which would I like to maybe look from a valuation perspective. Although a lot of TP points we have seen. So UAE is a unique jurisdiction where a lot of time multinational companies or groups, they don't carry assets in the country. So they carry assets in their home country, maybe let's say India, UK, or any other market. So what happens is they, for purpose of lending, they bring up the financial guarantees from those locations in form of SPLC or a security-backed guarantee. And based on that, they take lending in UAE. So is there going to be impact on this from a valuation or a TP perspective, which you want to highlight and share on?
Yeah, sure. In fact, this is a very big question that most of the companies face, in fact, because there are assets probably sitting in UAE also, and which can be used to give bank guarantee. And against that, there could be some credit lines which are obtained across. So there are different ways in which one can look at it. So there are, as you, when you went through Yogesh Bhai's presentation, you saw that there are these, methods which are listed for determining arm's length pricing. So the first one that obviously comes up is the comparable uncontrolled pricing. So if you have the, the guarantee commission rate for taking that guarantee from a bank directly or from a third party, that would be the best yardstick. But in most cases, I know that such things are not available. So then one should go with a with and without model. That is, with the guarantee, what is the rate of interest, and without the guarantee, what is the rate of interest. And of course, one cannot say that the entire amount of the entire percentage of differential is guarantee commission which should be paid, because otherwise, what's the point taking the guarantee? You would rather then take that credit line at that interest rate without guarantee. So then there would have to be an attribution which will have to be considered depending on certain judgmental calls. Yeah. So this is how one can look at bank guarantee.
This is just to maybe give a add-on point to what we are seeing from UAE. Generally, new companies don't get any credit lines. So technically speaking, a lot of time, if they don't have a bank guarantee, the business itself become non-viable. So maybe we can consider that additional profit you are making out of that line may also be part of the TP framework, which is quite a considerable thing which we're talking about.
But additional profit, I don't think one can really attribute to bank guarantee as such, So additional profit is something which is attributed to the IPRs that one cannot really attribute to guarantee. Guarantee is a very, I would say, it's a passive thing,
Perfect.
Would the
Thank
issues
you.
like
Yogesh?
would the issues like credit rating, etc., have any impact on this, on the valuation of guarantee commission?
That will have a bearing on your interest cost, no doubt. On your guarantee commission, because when you do a with and without, that credit rating is, we assume that it is at the same credit rating that you are doing a with and without model. And so the delta that you have is really only for the, the guarantee which is there. So we assume and we go on the basis of credit rating. So that is really to build up on the interest rate.
So I think the moot point coming here is it's not as simple. So we have to look at the various methods. So it cannot be a thumb rule which can be applied. That's what is coming up. I'll go back to Yogesh ji for one point you have raised on the TP side. There is again one very peculiar question which is coming up in almost all the sessions and discussions is what about managerial remuneration? That means taken by the owners of the organization or the key people. So do we need to apply the TP principles? If yes, then where we need to stop and what is the value threshold can be looked at?
Yeah, correctly. So as I covered in my talk, managerial remuneration, see, there are two aspects. One is it an allowable expenditure as such, being an expenditure incurred wholly and exclusively for the purpose of business? That is number one. Number two, if you pass that test, then the number two is whether it meets the arm's length pricing, because he's either a connected person, if not a related party. So these are the two tests one will have to see. So as I said, first and foremost, you have that clause 4 in Article 33, which says that a distribution of profit is not an allowable expense. So it goes out directly from the allowability kitty completely. So if you say that this managerial remuneration is nothing but it is in the nature of something which is a distribution of profit to my shareholder or the owner, then it is not allowable at all. Forget transfer pricing. However, if you say no, it is not distribution of profit. It is in the nature of a fee or a compensation which I am giving to him because he has brought on table something, he's rendering some service, or he has provided some technology or whatever it is. Then yes, that expenditure will qualify the test of being wholly and exclusively for the purpose of business. Then comes the question that is it paid arm's length or not arm's length? If it is arm's length, everything is allowed. If it is not arm's length, then partly it may be allowed, partly it will not be allowed. So remuneration, manager remuneration will have to be seen from that point of view. And the questions will definitely arise as to how do you really benchmark manager remuneration? And you see, if I say that, okay, look at the other companies of my size, what are they paying to their key management personnel? And that publicly available, that data is publicly available under the Companies Act in the audited accounts. Can I really say that, look, XYZ company is paying so much, that company and my company are more or less for the same size in the same business, and I am paying so much and therefore it is arm's length? Technically, the answer is no, you cannot do that, because what the law requires you to compare is a transaction between uncontrolled entities. So for that company X, which is paying to its manager a particular remuneration, that manager is a CP for that company also, and my manager is a CP for my company also. So you can't compare the two. Technically in law, you cannot compare the two. So therefore it becomes very difficult for one to really say what is. So therefore you say, okay, what this gentleman would have earned if he had gone outside, into an unrelated company? Would he what? So that those sort of things are extremely difficult. So one fairly simple way that we have invented in India, and which has worked in many situations, is that you look at the company law, you look at the company law requirements of managerial remuneration. So there are certain limits up to which the company law permits the managerial remuneration to be paid collectively to all put together and individually to a particular managerial personnel. And if I meet that criteria, then that is a criteria which the government, although under a different legislation, has enacted, and therefore I meet an arm's length price. In fact, pre-transfer pricing days there was a very old circular in India of the CBDT, which said that if the managerial remuneration is approved by the Ministry of Corporate Affairs for the Company Act purposes, then the tax officer should not say that this is excessive or unreasonable for the purpose of disallowance under the tax law. A very old circular, much before the transfer pricing provision actually came in. But then nonetheless, that principle would still apply. And by and large, the managerial remuneration in India is being benchmarked on that basis. Also, as I said, that TNNM is something, the transactional net margin method is something which is all pervasive. And if my company, despite having incurred managerial remuneration and despite having incurred expenses to my related parties, is earning an arm's length profit which is within the range of all third-party comparables, and if my profit is in range, then the presumption is that whatever you pay to related parties is within the range. So that is another way in which these issues are tackled in India. So that's how
Yogesh, maybe I'll summarize it in a simplistic way, which I had a conversation with a business guy. He said, I am withdrawing 200,000 every month. So why you are saying me now that I cannot withdraw? So my answer to him is, you can withdraw 1 million also, no problem. So far you have that profit and the reserves. Subject to point number one, what will be allowed as an equivalent, as you said, if you employ a CFO or a CEO in your position, what kind of a market salary you will be ready to pay. So that's something which may be allowed. And balance anything else is after the tax, you can take home. So what you want to. So Janak, you want to add up that from a UAE corporate tax, from a UAE LLC and listed entity perspective, the thresholds which are broadly there. Maybe 2 minutes will summarize that point from a managerial remuneration.
In UAE commercial company law, under Article 171 of the Public Joint Stock Company, that says that remuneration to board of director can be 10% of the net profit. That is the limits prescribed under 171, Article 171 of the Commercial Company Law. It says 10% of the net profit, and in year of loss, maximum amount you can pay to the individual director is 200,000. This is the two things. One may say that these are the provision applicable to Public Joint Stock Company, therefore they are not applicable to the LLC company. There the Article 104 of the Commercial Company Law states that whichever articles or whichever areas the Commercial Company Law has not covered for the limited liability, what is covered under Public Joint Stock Company area, that will apply to LLC companies also. So that 10% of the net profit may be coming by way of a management decision or cabinet decision as a safe harbor rule as far as corporate tax is concerned for the management remuneration. Please note one thing, these are only for the board of director taken as a whole, but it does not cover officers as defined, and Yogesh Bhai has very correctly taken under Article 36. The definition of connected person includes officer, which can be division heads, which can be president, vice president, who are not on the board of the company. That needs to be taken care, as Yogesh Bhai explained separately, or descriptive analysis of total needs to be proper documentation needs to be done. Why I am paying so much remuneration, and that may be given. This is my view on the matter.
Perfect. Thank you. Thanks, Janakji. I'll just pick up a couple of questions which are there on the Q&A. So first question is coming from Dharmendra, which saying we have thousands of transactions and can we adopt a standard percentage method? That means adopting 0% of tax up to 375,000 and beyond that paying 9% and ignoring the arm's length principle. So I think answer is two-way. Point number one, you can adopt the standard principle. That means no taxes up to 375,000, but you cannot ignore the arm's length principle. So that's what is coming up. Whether you are in free zone or in the mainland, you are qualifying, non-qualifying, the arm's length principle has to be adopted. So there is no escape coming from their side. Amit Pathak is asking a question, Jananji, maybe I can refer to you from a tax group perspective. So what he is referring is they have individuals who are holding the companies. So there is no technically a parent company, but they have 5 different licenses. From a ownership perspective, is a common ownership, and they have a VAT group also. So I'm assuming it is more than 95%. No companies are 0% tax, and they have the same financial year. So how they can make it a tax group is what the question coming up.
Impromptu answer is that yes, a tax group cannot be formed because they are saying residential juridical person. They are saying they have calmed out individual from that. So shareholder cannot be individual. And if there are 3 individuals who are shareholders of the company, an example, and all the 3 are owning whatever percentage of shareholding, and these 3 individual 100% owner of all the 5 entities. But impromptu answer is no, because of the requirement of article of the commercial this corporate tax law.
Perfect. We will wait for a couple of more. Maybe I think this is the larger aspect. I'll recommend that let's wait for the cabinet decisions to get into a more perspective. Only pointer which comes here is the law says that it is applicable for judicial, non-judicial, registered, unregistered companies and everything. So maybe we have to wait and see how the cabinet decision takes into. We have 2 raised hands, so maybe Bashir Ahmed, if you want to unmute yourself and talk and pick up a question. And we have Lokesh also. So I'm keeping both to unmute and maybe ask the question if they want to. In the meantime, Bruce Lee, just a question to you also from a valuation perspective. So any specific actions you tell people to take care for the past transactions which may have happened? Maybe the balance sheet closure which is happening before the corporate tax comes into play from your side.
Yeah, so if there are assets which are created, and I think some of the things that Yogesh Bhai covered up in his talk, which was about the receivables, payables, and where transactions were between related parties, so they have to be restated, as he said. Other quite important things would be also the IPRs, which are otherwise, made available. So there could be technology which could be made available, and there can be with or without royalty. So maybe you can even look at that. You will have to restate if there is IPR ownership which is transferred, then one has to see what is the value of that IPR. And if it is just on the base of royalty, obviously, then there's no adjustment to your assets as such. But only thing is that if it is made available in the past, then without any charge, then in that case, maybe there should have been a receivable. So there's actually no end to this kind of an adjustment. So there would be so many transactions which would have happened between group companies before this law came in. So if there is some technology which is made available and there is no charge for that, then you will have to show some payable to your group company for that. I don't know how it will have to be. It's really a very, very dangerous kind of an adjustment which is called for. I think somewhere some clarity will have to be given by the government on this adjustment.
You are right.
You're right. If I can just
one point,
Ajivji.
Yeah, sure.
Even right to use will be an asset under IFRS. Okay. So if it's a mere right to use, you will have to value it, I suppose. If it is a right to use from a related party, you may value it and keep it. So it's not just a transfer of inventory. I believe that even right to use may have to be valued.
Maybe Yogesh, I will have a little bit of different view on the right to use asset, because that's not my capital structure. That will be my you can say working capital or a running expenses structure, and that's where they have differentiated between unrealized profits and gains. So I think we need to add up over there. But definitely, as you said, there is a lot of interpretation there, and transition rules are never easy. And what we are believing that corporate tax will start, and we'll start looking at the books. I think we have to start looking at maybe a couple of years back also. It's not as straightforward as anyone said. We'll pick up maybe one or two questions from the audience state. Bashir,
One
you
minute.
can unmute and
Rajiv
ask
ji,
for.
Rajiv ji, Putran
There
sir
will be
wants
one.
to ask.
Yeah,
Putran sir wants to ask. He has raised the hand and he wants to ask certain question. Putran ji is there.
You can unmute themselves, and Putran ji,
Yeah.
please go ahead.
Putran sahab.
Simran, if you can help to
We can
unmute,
take.
there are 3 raised hands. Maybe unmute all so that anyone who wants to ask can do it. I think Tirath is there.
Yeah.
Tirath, you can ask a question if it's there.
Bashir,
Okay, I don't think we are
Yeah.
able to connect with them, or
Yeah. Meanwhile, you can continue.
no. I think there are a lot of questions, and I'm sure these questions will not end up to the level we go into. I'll recommend maybe look at Tally, a lot of webinars and sessions they have conducted. We can maybe look at those webinars pointers, and we are already overshooted the time. Back to you, Simran, for the closing comments, and we take it forward from there.
Thank you so much, everyone. I'm sure after such a healthy discussion, we were able to offer great clarity on the subject. However, we do understand it is limited time in hand. There are a couple of questions that do remain unanswered. But with more clarity flowing in, we aim to host many more such sessions in coming days and weeks. And we request you to stay tuned and register for all the upcoming sessions. I would like to thank our speakers and our panels, that is CA Janak, CA Yogesh, CA Rajiv, and CA Drishti, for accepting our invite and delivering such an insightful session. A big thanks to each one of you for accepting our invitation and taking out your valuable time to attend this webinar. We appreciate you all being here. Please have a great weekend ahead, and thank you so much. Thank you, everyone.
Thank you.
Thank you.
Thanks all. Wish you a great day ahead. Take care all. Bye.